Sometimes we say things out of anger or sadness, but this doesn't mean you should make bad money decisions due to your emotions. Remember, money is a commodity, and we should treasure it. In this video, I will share 5 life-changing lessons from The Psychology of Money. Exploring the intricate connection between emotions and financial decisions, we'll delve into valuable insights that can reshape your approach to money and contribute to a more mindful and prosperous financial journey. Join me as we uncover the wisdom that can empower you to make informed and emotionally intelligent choices in your financial life. 1. Pay the price. One of the significant emotional traps identified by Morgan Housel is the tendency for individuals to underestimate the psychological and emotional costs associated with financial decisions. Often, people focus solely on the monetary aspects of a choice without considering the toll it may take on their well-being. For instance, a person might opt for a high-stress job that pays well, disregarding the impact of long working hours and a demanding environment on their mental health. In such cases, the emotional cost, which may include stress, burnout, or strained relationships, is not adequately factored into the decision-making process. This trap highlights the importance of considering both the financial and emotional consequences of choices to achieve a more balanced and sustainable approach to personal finance. Example: imagine an individual who accepts a promotion that comes with a significant salary increase, but also requires working 70 hours a week. The financial reward is clear, but the toll on mental and physical health, as well as personal relationships, is often underestimated. In this scenario, the emotional cost of stress and strained relationships is the hidden price paid for the apparent financial gain. To avoid falling into the pay the price trap, individuals should prioritize holistic well-being in their decision-making. Recognizing the importance of work-life balance, mental health, and overall life satisfaction is crucial. Regularly evaluating the emotional costs associated with financial choices can lead to more informed decisions that contribute not only to financial prosperity, but also to a healthier and more fulfilling life. 2. Magnitude of chance. The magnitude of chance is another emotional trap wherein individuals tend to downplay the role of luck or unforeseen circumstances in financial outcomes. People often attribute success solely to their skills or efforts, neglecting the influence of external factors. Consider an investor who experiences significant gains in the stock market during a period of overall market growth. While the investor may attribute these gains entirely to their investment acumen, the broader market conditions and economic factors also played a substantial role. This trap can lead to overconfidence, prompting individuals to take excessive risks or not adequately prepare for unexpected downturns. Recognizing the role of chance in financial outcomes is crucial for making more realistic and well-informed decisions, mitigating the potential for financial setbacks due to overconfidence. Example: an investor might experience success in the stock market during a bull market and attribute it solely to their stock-picking skills. However, they may overlook the favorable overall market conditions that significantly contributed to everyone's success during that period. This oversight can lead to overconfidence, potentially causing the investor to take on more risk than is prudent when market conditions change. To avoid succumbing to the magnitude of chance trap, individuals should embrace a mindset of humility and acknowledge the inherent uncertainties in financial markets. Diversifying investments, staying informed about broader economic trends, and seeking professional advice can help individuals navigate the unpredictable nature of financial markets more effectively. Cultivating a realistic understanding of the factors influencing financial outcomes can lead to more balanced decision-making and a resilient financial strategy. Now, before we dive deeper into the next point, if you're finding value in this discussion, take a moment to hit the like button and subscribe to the channel. It really helps support the content, and you won't miss out on future insights. Let's continue with our exploration of the lessons from The Psychology of Money. 3. Wealth is what you do not see. In the wealth is what you do not see, individuals often fall into the misconception that wealth is synonymous with visible signs of affluence. This entails a fixation on outward displays of success, such as luxury cars, large houses, and expensive possessions. However, this trap warns against the oversight of the less apparent aspects of wealth, namely, the financial habits and behaviors that contribute to true prosperity. This emphasizes the need to look beyond the surface and recognize that true wealth is built on sound financial practices, responsible decision-making, and a holistic approach to financial well-being. Example: consider a person who decides to upgrade to a larger house and buy a luxury car to keep up with the perceived image of success. While these visible signs may project wealth, the individual might be overlooking the financial strain and debt incurred to maintain this appearance. The true wealth, in terms of financial stability and responsible choices, is not immediately evident. To avoid falling into the "wealth is what you do not see" trap, individuals should prioritize financial habits and behaviors over conspicuous consumption. Building true wealth involves prudent budgeting, saving, and investing for the future. Evaluating financial decisions in the context of long-term financial well-being, rather than short-term appearances, can foster a more sustainable and fulfilling financial life. Recognizing that true wealth goes beyond outward displays and encompasses financial security and responsible choices is key to avoiding the pitfalls of this trap. 4. Use money to buy control. In the use money to buy control, individuals believe that spending money can provide a sense of control over life's uncertainties. This might manifest as impulsive spending or hoarding money as a way to maintain a perceived sense of security. Example: an individual might resist making investments in the stock market, preferring to keep a large sum of money in savings accounts. The motivation behind this behavior is not a thoughtful investment strategy, but a desire to maintain a sense of control over their finances. However, this approach may lead to missed opportunities for growth and increased financial security. To avoid succumbing to the use money to buy control trap, individuals should differentiate between genuine financial control achieved through informed decision-making and illusory control derived from impulsive spending or excessive saving. Building an emergency fund, creating a well-thought-out financial plan, and making strategic investments can provide a more secure foundation without succumbing to the false sense of control associated with excessive spending or hoarding. Recognizing that true financial control comes from thoughtful planning and strategic decision-making can lead to a more balanced and effective approach to managing uncertainties. 5. Contrasting narratives. The contrasting narratives involves the influence of stories and societal narratives on financial decision-making. Media, anecdotes, and societal expectations shape perceptions of financial success and failure, often leading to distorted beliefs and expectations. For instance, societal pressure to conform to a particular lifestyle or achieve specific milestones can drive individuals to make financial decisions that align with those expectations rather than their own values and goals. Example: if societal narratives emphasize the importance of homeownership as a marker of success, an individual might feel compelled to buy a house even if renting aligns better with their financial goals. The contrasting narrative of homeownership as the ultimate achievement can lead to decisions that do not align with the individual's unique circumstances and objectives. To avoid falling into the contrasting narratives trap, individuals should critically assess the narratives shaping their financial choices. This involves reflecting on personal values, establishing clear financial goals, and making decisions that align with one's unique circumstances. Developing financial literacy and seeking advice from diverse sources can empower individuals to make choices that resonate with their own narrative rather than conforming to external expectations. Recognizing the diversity of financial paths and understanding that societal expectations may not align with personal goals can lead to more authentic and fulfilling financial decisions. I hope you found these insights from The Psychology of Money valuable and thought-provoking. If you enjoyed this video and gained some wisdom, don't forget to hit the like button, subscribe for more content, and ring that notification bell to stay updated. Your support means a lot. I'd love to hear your thoughts, so please drop a comment below, sharing your perspective or any other topics you'd like me to cover in future videos. Thanks for watching, and I'll catch you in the next one.